welcome back to our 43rd edition of our weekly Wook and Review broadcast. I'm Wook Capital Management Managing Director Rod Alsman. I look forward to our discussion today. We should probably we'll cover some single names, we'll cover general macro, some sector discussion, I'm sure, and industry discussion. As we're in the midst of earnings season, there's been a lot of results, so we can talk about a lot of different things. The plan will be to go through our prepared material, which I will bring up on my screen and share. Joe has the thread pinned, but I'll go through that. Again, you can listen audio only on Spaces. You don't need to follow on screen, but if you'd like to follow on screen, I am sharing. It's in the GMEDD Discord, which if you're not in, you can find the link to that. I guess it's now the wook.gg link brings folks there, Joe, you said? Okay,
Yep.
cool. So, all right, with that said, let me read my disclaimer so that none of you gentlemen and ladies decide to sue us. Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients. We do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. So all that to say, do your own due diligence. All right, so let me get my face out of the middle of the screen and we can walk through the prepared material that Joe put together in this morning's newsletter. Thank you, as always, Joe, for doing that. So we'll start off, look, we put out our first single stock research report as Wook Capital Management this week. We did it on Sunday. Our PLBYDD report. So that's been available. We welcome folks to dig into it. Would love to hear any feedback that you might have. We hosted a 2-hour kind of overview talk about the report and its contents, and fielded some Q&A as well. So that's on both my Twitter, it's on the Wook Capital Twitter, the @GMEDD Twitter, which, as you may have seen, the name has been changed to due diligence, for now. You can access the files if you'd like at plbydd.com for the main report, and then there are a couple pieces of supporting documentation. We put together an asset deck that walked through the valuations that we came up with for the various assets that they own. So you can access that at assets.plbydd.com. Our model for their creator platform at model.plbydd.com. And then I think, Joe, you made it. What was it that you made the link if people want to catch the replay? Joe?
Yeah, you can check out the Playboy report review spaces we hosted. It'd be review.plbydd.com.
Okay.
I'll also pin it in the nest here.
There it is. Cool. So, I had an interview with the gentleman at Chit Chat Money that came out yesterday. On that, I also had an interview with them on Allison Transmission, which made all-time highs this morning after another solid earnings result yesterday evening. So feel free to check out any of that material. I do my best on securities that I'm kind of willing to talk about like that in detail to be deeply knowledgeable, because that's the goal, right? To know as much or more than anyone else. Okay, so with that, then we've got more highlights going on in economic activity. It's just been, I think it's really hard. If you were a perma bear entering this week, you've been beaten and you are probably in a daze at this point, because the week went by with just a lot of a continuation of, I think, good economic data if you are in the soft landing camp. Um, the markets have embraced the economic data, right? Indices continue upwards. If we go and look, just over the last week at the major indices, my internet wants to work. I guess it doesn't. But at least today, NASDAQ up another 2%, up over 2% on the week. Small cap Russell up over 1% on the week. S&P up over 1% on the week. Year to dates, just incredible. And then volatility, while we had a brief resurgence of volatility for all of one day, volatility closed down close to 13 again today. So indices up, and it's this ongoing cooling of cost pressures throughout the economy. There was data from the employment cost index that came out this morning that showed that wage increases, that rate of change continued to cool off. That's been a big concern for the Federal Reserve, that the excess demand for labor relative to the supply of labor had been a risk of this kind of wage price spiral, which fortunately for the Fed and for kind of small landing fans, not small, Jesus, it's Friday. For soft landing fans, that rate of increase slowed from 4.8 between January and March of a year earlier to 4.5 over the last quarter, the second quarter from a year earlier. So that rate of change continues to decelerate. And the Fed would like to see that continue down. The personal consumption expenditures, which is the real inflation metric that the Federal Reserve targets, even if it's not the metric that the public writ large feels. One I remember, I don't want to go in the weeds on this. When I worked at Ryder, one of the first projects that I had was for evaluating alternative inflation indices to kind of identify what could be a better way for the business to price inflation into its contracts. So there's the CPI, which everyone kind of knows, but there's actually several different sub-tranches of CPI. There's the CPI-U, there's the CPI-W. CPI, based on the math, almost always will come in higher than PCE. I won't go into all the weeds on that, but that was a fun project where basically the company had been using CPI-W, and the final answer was, well, why don't we just use the gauge that's going to basically allow us to inflate pricing the most? I mean, CPI-U had been increasing at a faster rate than CPI-W. So that was the proposal. I don't believe that was ever implemented though. But anyways, fun inflation times. But PCE, let me get my head out of the way. Big decrease month over month, which is nice for the inflation is over folks. You had PCE headline only up 3% year over year in June. The core PCE was up 4.1, which was a big deceleration from May, which was 4.6 year over year. So good news across the board. Employment cost pressures dissipating, PCE continuing to trend down toward the Fed's goal. So I think this lends more credence to the view that rate hikes could be done. We look at where the current Fed funds pricing is for the next meeting. It's down now to a 1 in 5 chance of there being another 25 basis point hike in September. If we go to year end, there's a 25% chance that there is one more hike, but it's much more likely priced currently in futures that the terminal rate's been reached. And I think if the data were to continue coming in, either in line with estimates or light like it did today, then you could definitely make the case that there don't need to be more rate hikes. But we'll get more data in the next couple of months. But it's really hard to argue with the economic data look pretty good. The risk, I think, is that everyone gets so complacent and then we get into the next quarter or two here, where the excess savings that's been accumulated by um, most consumers. I mean, you can break out the consumer bases, but on Wednesday, I think we talked just a little bit about, there's different signs of some consumers slowing, different tranches of consumer, right? Earlier this year, it became clear that a lot of maybe the lower income consumers had run out of gas, run out of excess savings, and you get mixed messages. If you ask the banks, JP Morgan, B of A, they continue to say that their consumer base across income brackets have more cash with them. And then, depending who you ask about excess savings, some kind of see excess savings being exhausted in a month or so. Some see it later in 23. But I think the big telltale sign that the real economy is, really able to continue, even with what is clearly a moderately restrictive interest rate policy, will be as we get into the holiday season, as many consumers begin to have this incremental debt repayment that gets toggled back on. Are they able to continue to drive the economy? Because the consumer is the bulwark of the American economy. And even though aspects of the industrial economy, freight markets in recession, certain manufacturing spaces in recession, clearly the economy writ large is not in recession. And the consumer's strength on the back of having so much excess capacity to spend and being fully employed is carrying things along the way. So yeah, there's some economic discussion. Happy to let folks chime in once we get done through the prepared material. One other kind of big headline item that I had Joe include was on the labor front. We talked the last couple of weeks about what's going on at Yellow which looks to now be that they'll file a formal bankruptcy on Monday or by Monday. Yellow being that large less than truckload carrier whose Teamsters, employees had effectively, the threat of their strike, I think, is going to basically force this into bankruptcy. Clearly for the Teamsters, though, maybe thinking big picture, they did have some success with that strategy. While Yellow will fail, UPS is their largest. There's over 300, I think, 40,000 unionized workers that they're at UPS. It's the largest Teamsters employer, and they did reach a deal this week. So they have a new 5-year contract. There would have been a devastating strike that would have started on August 1st if they had not come to terms. But I think a very important question that Joe included here was, quote, once the dust settles, the big question for shippers is what the company's general rate increase looks like for 2024. And I saw a story in FreightWaves yesterday that I have on my screen. The headline is UPS shippers may face double-digit rate increases in wake of contract. So, UPS comes to an agreement with Teamsters. They're going to pay Teamsters a lot more. They're going to hire more of them. That's wonderful, for labor, but that adds a lot of cost to the model. And therefore, UPS, Carol Tome, the new-ish CEO, doesn't want margins to deteriorate. And that means that prices must go up. So the story quotes a few different logistics leaders who are in the weeds on this stuff, and their view is that the general rate increase for 2024 is likely to be in the 11 to 12% range, which is inflationary, right? I mean that's a much higher rate than a natural rate increase, I guess, would be. The cost increases from this agreement with Teamsters is going to lead to another big rate increase for shippers, and shippers are unlikely wanting to allow that to eat into their margins. So I think the expectation would be that the elevated cost of shipping gets baked into the end price that a consumer pays, whether that's on a parcel delivery or on food and beverage. UPS is more on the parcel side, but if other players in the space see them taking rate and price up this much, I think you'll probably see FedEx look to match. And Yeah, so it's inflate. I would say the agreement, all else equal, is an inflationary one. And while it's good that we're not going to have a big shutdown that would throw a big wrench in in shipper networks, um, yeah, you're just going to see, and the vote still has to get approved, but I think that it's more of a formality at this point. So yeah, good news for Teamster employees, maybe bad news for folks who like to do a lot of online shopping. Okay, so Joe included a story that I thought it was a good read. It was on this Stanley Black and Decker factory that got built in Texas, and was intended to be made in the USA. Craftsman tools. Uh, they just failed though. The factory was, well, that link didn't work. The factory had been built, like 3.5 years ago, and while for years now they've been trying to get things working right, um, they're going to be shutting it down, and they're now advertising it for sale. It was an automation system that was supposed to make the tools so efficiently that costs would be on par with China, but they just weren't able to get there. And there's been a few different stories, in Bloomberg and Wall Street Journal and others, kind of talking about how for a lot of these industries, there's just been a lot of tribal knowledge lost from the exporting of different manufacturing processes and jobs offshore over many decades. So, while we hear a lot about reshoring, right? I still tend to think that, but for the very aggressive incentive policies out of the US government for certain industries, such as semiconductors via chips, certain infrastructure spend, certain battery related investment, you know, that the other stuff that maybe there isn't as much of an incentive to reshore it to the USA will instead be a part of a broader China plus one manufacturing strategy where there may be a facility in Mexico that augments the facility in China or a facility elsewhere in Central America or South America, uh, in a lower cost country, be it Mexico or whatever, that has is close enough to the end consumer that you can make the supply chain more resilient without adding too much cost to what had for many players been a sole sourcing out of China, as they retooled their supply chain. So, no pun intended, the retooling of Craftsman as made in the USA failed, and it's unfortunate, but it could be a sign that some of these reshoring efforts won't go as smoothly as maybe politicians hope. Um, Last item was the news at late last night from the Bank of Japan that they appear to be shifting away from their longstanding yield curve control policy. So the yen jumped, treasury yields jumped. This obviously happened last night before the favorable employment cost index and the PCE news that I just talked about at the onset happened. So that did send equities down after the news came out briefly, although of course today they had a great day on the back of the other news that took more priority. But them backing away from yield curve control could be negative as you see Japanese investors potentially repatriate their investments abroad, to invest in more favorable yields at home. If you see yields rise from 50 basis points to 75 or 100, whatever, for Japanese investors, that may be the decision that they make. So we'll see what happens. But that was big news out of Japan last night. So okay, that's all I had for prepared material. Kind of went through it quickly. I would be happy to have anyone kind of chime in on any of that stuff or any other stuff Monative. Would love to hear if you want to maybe talk about anything in the earnings that's been catching your eye. Would love to hear it. Anyone else who wants to tune in, my intention would be to keep this open until for another hour and a half, so long as we have good discussion and questions and comments. So feel free. Again, if you're in the Discord server. You can submit a question via the Stages channel, and just type away. And obviously, if you're here in Twitter, you can come up and use your voice. You can hear that. So hey, Mondiv, happy Friday.
Happy Friday. So we lost a little, gained a little, and we're nowhere any different from where we were on Thursday. It's just one of those things. So interestingly enough, that long, whatever, day-long space that Tony ran, which was the bear cave, basically, everybody that's mildly bearish was up as a speaker there. So got into a little bit of an argument there with one of the people, and this was purely about DeMark and DeMark exhaustion. So for folks that don't know, DeMark basically is sort of like a counting indicator of strength, and at a certain point he noticed patterns of trend exhaustion, whether that's on the upside or downside. And he created indicators that are heavily used by very large money managers, big hedge funds and stuff. Whether you believe that or not, that's a different part of the story, but it's got a lot of cachet. It's used heavily. It works well sometimes and doesn't other times. Like any other indicator, you have to take it in context of, of the strengths in the market, but also as just one among multiple inputs to be able to be used for decision making. Anyway, long story short, I follow DeMark. I have been for many years. Though I sort of am losing faith and saying it's time to move on. It's an expensive uh, tool for what it does. But for how I trade, picking tops and bottoms is important. I trade, reversals, and that's exactly what DeMark does. So when you learn to use it well, it's useful. But anyway, sorry for that long-winded introduction to what I was going to say. So if you look at the risk-on sectors, right, which is basically technology, communications, and uh, um, what is the other one? The consumer discretionary, right? XLC, XLY, XLK.
The three sectors
Those
that
are
led today.
the three sectors that have been leading all year, right? These things are
That
up
too.
roughly 40% each year to date. So we've had many periods where for almost as long as a week you see confirmed exhaustion on the daily, but it's not really translated to an exhaustion on the weekly or monthly time frames, basically meaning that trends are short term changing but reverting back to a longer term continuation of the pattern. For the first time this year, um, technology XLK has a potential to have a top on DeMark exhaustion, basically at DeMark 13, signaling a local top, and then you have to watch for confirmation. Of course, today is not the month end, so you still have to wait for Monday close to to get a signal. But yeah, it is still on trend for the other two, communications and discretionary. Of course, for communications, the strength of Meta and Google overrides the rest of the sector. They're just such a large weightage, right? Which is that whole other discussion we've had at multiple times. Is what is the meaning of a strength in the sector when the sector strength is really pulled by the top of the list. Anyway, I just thought I'll throw it in there. So in a very long time, this is the first real exhaustion that potentially could be confirmed. And if it does get confirmed, then all it means is that there is a risk of reversal. You really want to go back to your other signals and look at it. And I mean, look, hedging is cheap. You can always find a way to hedge it if you want to not take out your positions. It's the cheapest it's been in a very long time.
Yeah,
So
I'm sure you've seen it, just for the folks who maybe hadn't seen it, that the cost on S&P to hedge, a lot of people have been sharing that, that you're talking about like the cheapest it's been in many, many, many years. Trying to find it, can't find it, but I'll put it on my screen in a second. There it is. Yeah, for the S&P 500 at least, to get a 1 year put, it's actually the lowest level on record. So if you've been long tech, which is the largest constituent of that index now, and you've had great gains, it's pretty darn cheap for you to protect some of those gains. But it still doesn't feel like we're in a market where people want to pay for downside protection, which is why it's so cheap.
and that was the context in which I posted that tweet. Is it's one thing to say there is rotation. It's another thing to actually see data that supports it. There isn't any data that supports a rotation out, right? We are still very risk on. Potentially we could be weakening, but we are still very risk on. I posted my tweet up there and the chart. So that's from DeMark. So basically, it's the top three are the three sectors on a daily. Then you have the middle three are weekly, and the bottom three are monthly. It's an easy visual to see, in one page how to read the market on multiple time frames for sectors, and I look at different variants of this on a daily basis or multiple times in the day, when depending on the time frames. So yeah, it is. There isn't an active rotation that sustains. That's the problem. There are always rotations, but for them to sustain, it needs a continuing, sell out of a sector and buy into another sector. And what we are really seeing is occasional profit taking, um, that could go on for 3 4 5. We've had 3 4 5 sessions sometimes where there is profit taking,
Well, I know, Manu, you've been
and then it
closely
just goes
monitoring a
back.
lot of the industries within industrials, and like XLI had been, even by the end of May, had been basically flat year to date. But in the last 2 months, XLI has run up 13 or 14%. Uh, I know you, in like the aviation, I know you were talking about, I guess, I guess fueled by this continued impulse by consumers to return to traveling, that like a lot of whether it's aircraft engines, whether it's people that kind of benefit from that increased activity. I know Royal Caribbean is not in the air, but it's at sea. They had a good result this week. They're not, obviously not an industrial, but I guess what I'm trying to say is that there has been some rotation in some spaces.
Yeah. No, industrials is very interesting. In fact, if you zoom out a little bit on industrials, if you go 52 weeks, industrials have performed, better than discretionary. Industrials are the third best performing sector 52 weeks, so 18%, 17.5%. What has happened is, the weighing down of the industrials by aerospace and defense has pulled it down. They're negative for this year, and they're even more negative towards the end of last year. So that's what's weighed down, right? So industrial is still the fourth best performing sector year to date. But if you look at, so this is what happens when the rest of this, when a group of industries is overpowering even the largest part of the largest component of an index. it is something else to see. So aerospace and defense is about 27% of industrials total, because the handful of companies are very large, right? You have Boeing, Lockheed, Raytheon. They're all massive companies. So you add it all up, it's a big chunk of industrials. And aerospace and defense is down 1.5% for the year, and industrials are up 12% for the year. Without if aerospace and defense was actually running, and it gets even weirder because Boeing has been running all this while. So it's really the defense side of it that's been down, and it's been down a lot. uh, this is where the nuance of breaking it down into industry and sub industry classifications, and then looking at individual stocks, becomes really important in understanding rotations, right? I mean, construction and engineering is up as much as software. It's up 40%. Right? People don't understand that. They think the only things that are up are seven stocks. It's not. I mean, trading companies as an industry group are up 27%. Airlines are up 25%. Right? These are better than most of the tech stocks if you think about it.
Yep.
So
If I
there
could
has
just,
been
Mahmoud,
outperformance.
interject a comment in line with what you just said. Allison reported earnings yesterday after hours, and they said, quote, "We see medium duty continue to be very strong. They see vocational," which when you think about vocational, we're talking about trucks hauling concrete. It could be hauling building materials. This is, a straight truck working on like a job site potentially. But they noted that there's underlying support there in terms of vocational drivers such as infrastructure spending, and as I know you've heard me say before, the fact that those trucks hadn't been produced at the same frequency as um, you know what the OEMs prioritized when they had manufacturing and supply chain constraints. So there's definitely, they are seeing, and PACCAR noted this, really solid continued demand for a lot of these work trucks, which means that that work is still continuing in the construction space, fueled by a lot of this fiscal spend.
Yeah, I mean, industrial reconstruction is going to need lots of concrete trucks, and probably they've not been renewed in God knows how many years. So and if we had actually done the original Build America plan with all the road construction and stuff, it would be even larger, right? So yeah, um, it is very interesting. So. It does talk a lot about the deep underlying strength in the market, right? And that's important. People should realize that when they see the headline indexes, your S&Ps and Qs selling off, even when they're selling off, it doesn't mean the market is unhealthy. I would actually say the other way around. It is healthier for the market to rotate and have other industries also do well, and start to take on some of the weight of moving the market. But you're not going to see it in the index, right? The index could go down 10-15%, and we could have a very healthy market where companies that have good fundamentals, good technicals, but have not but have still been sold off because they're not running as much as the tech side of it, and they will continue to come into play, and they're more fundamentally defensible companies. So I think that's what we're going to see in the second half of the year. Here is not so much a liquidation of tech, but rather selective profit taking. So you capture some of your gains, and then instead of putting it back into just the lower level of tech, you start to spread it out to sectors that are strong, that have multi-year or multi-decade uh, macro tailwinds, right? Like we know Boeing has what, 4,789 or something I saw yesterday, backlog. That's a few $100 billion, something like 300-400 billion in backlog. I think that's the second largest backlog in the universe. I think the largest one is Airbus, because they have almost 8,000, 7,900 in backlog. So I mean, Lockheed Martin has 170 billion, Northrop has 100 billion, GD or 80 billion, GD is 100 billion. You start adding all these backlogs, they're like, few $1 trillion. So these are companies that have tailwinds for, better part of a decade now, right? And these are not orders that get canceled easily. Boeing maybe a little bit. It's been all over the map, but mostly their own fault rather than actual market conditions. So it is possible to see a very healthy market by rotating it into where the strength will be for a long time to come, irrespective of market conditions to a point, right? We're not going to cancel a defense program after it's launched. We're not going to cancel orders in Boeing without an expense associated with that. So and the waiting list is 10, 12 years, in worst case. So those are not, or sorry, 9, 10 years in some case. So those are not necessarily orders that are going to win you anything other than a news on a day and maybe a few cents that day. But they're not going to affect you badly either if they get canceled, right? You just move. When you have such a large order book, you just move it around. You move a customer who's happy to take it, while another customer wants to shuffle and switch their orders, and that happens a lot. So anyway,
It's a good problem to
long-winded
have when
way
you're
of
a
saying we need
manufacturer and
rotation.
you're trying to shuffle and prioritize builds. Again, I don't know the aerospace nearly as well as you, but I know that did happen on the truck side where the OEMs were constrained, just like I have on my screen the Boeing transcript, and they basically are saying just that on defense orders they're still supply constrained. But that's what the truck OEMs did. They built the you think your big rig sleeper tractor where the guy or gal driving it, sleeps in it and drives over the road. That's the stuff that was prioritized, at least in the trucks. And now that's where what we're hearing from the OEMs now is that they can now shift production priorities with the over the road market weakening. There's still so much strength in vocational and medium duty that they have still a big backlog to work down, which is why a lot of them, Packer already noted, they've filled up their order book through the end of the year. And it's not just them; it's Daimler Truck and Traton, formerly Volkswagen. So there's definitely a lot of good, I think, news. For the perma bears aren't going to like to acknowledge it, but fiscal policy has repercussions, and fiscal policy is
Well,
injecting a
that's
lot of
the
money.
that's the funny thing, Rob. Rod. Sorry, the most of the perma bears that you hear on FinTwit, I'd say a vast majority of them are not actually short the market. Most of them are in a sector that's not running. They consider themselves bearish because it's not work for them. So, there's a lot of energy bulls, for example, that sound very negative. They sound bearish, but only because it's everything but their sector that has run in the last year, while they had a great time in first half of 22. So I think we're gonna see rotation and significant rotation, but again, right, you have to consider how that is going to look at a headline level versus how that's going to look in reality. As far as your portfolio is concerned, it shouldn't matter, but you shouldn't worry about selling out in a panic when you see the index down but your stock's up. That's a good thing. That doesn't mean that the market is breaking down. It just means that we're taking profits at the top. So so Boeing, right, is an interesting story. I don't know how much you saw Northrop's report yesterday and Raytheon's report a few days ago, right? So Raytheon has to deliver a fix for their geared turbofan engines, GTFs. That's going to affect somewhere between 1,000 and 1,200 engines, and potentially cost about $2.5 billion. So they have to, um, they have some issue with one of the metal parts that needs to be verified and if necessary fixed, right? So 2.5 billion is a worst case scenario. But where this is interesting is all of those are Airbus aircraft. Boeing does not really do anything with Raytheon for their current fleet. They do have, some replacement stuff and, some minor stuff, but really not much at all. So one, this sort of hobbles Airbus for a while because they had the advantage of having multiple engine vendors, including Boeing, Safran, and Raytheon for their, the 300 series, and they ramped that up, right? They were making 79 a month versus, Boeing making 35, 36 a month. So that's an opening for Boeing to either, you know, push through farther out orders because it's a shuffle from an Airbus order that might be delayed, for example. So that I see as a positive. Another thing is a rather weird one is Northrop walked away from the next generation air dominance. So NGAD,
It's
as
funny you
it's
say that. I
called,
literally have that on my screen right now in the transcript.
yeah, NGAD as it's called, is basically the future replacement for F-35. Right? Why are we replacing F-35 now? No, we're not replacing. F-35 has a 63-year lifespan, or planned lifespan, right? And that includes two major overhauls and two major upgrades and a host of minor upgrades. So NGAD is supposed to be a next, much more stealthier technology, and frankly, there's been a lot of problems with F-35. It's been sort of a disappointing, next generation plane. It's not really hit all the flying specs that was originally intended to. The cost has been all out of control. The quality has been horrible, and sadly we lost another one yesterday to an accident. So it's been two this year. So it's not a good thing. NGAD was supposed to be a two-vendor competition, and until a couple of days ago, the rumor was that DoD was not happy with Lockheed and didn't want to give them another program when Lockheed had still got another 30 years or so delivering F-35s, and it was rumored that Northrop was the leader in that. So for them to walk away, it's funny. One of the analysts actually asked, like, "So you worried about the? So you wanted, or he's something to the effect of you wanted to avoid the winner's curse in this big, defense order," and he got a chuckle out of me. But yeah, there is a winner's curse in defense because you kind of promise a lot of things based on very tight specs that are you know really undesignable in a sense. It's really balancing out so many hundreds of requirements or thousands in some cases, and getting a substandard result. Then if you pick the right things based on the right requirements, just based on what can be done with existing technology, and prioritize only the ones that are most needed. Uh, we still do that, but we add so many things that are must-haves for the defense, right? And F-35 was like a one design fits all, and it became a design that fit nobody perfectly.
That's a good point about like a lot of these. If it's a next generation program, if you're a contractor or manufacturer, you don't want to have to go build a completely new set of componentry for something that you don't even know if you're going to win the contract on, and make all of that capex investment in just a pursuit of a program. Like I know at least on the Allison side, they have this transmission that's been in the Abrams tank for decades, and the wonderful thing is Now Turkey and South Korea and Egypt and other countries are buying, these variants of this transmission. But if you're somebody like Allison, you've been making the transmission for decades. There's not really any incremental, you know, there's not material retooling or capex or R&D that you have to spend when you can use an existing piece of hardware, or you can repurpose it. So that's a good point. You don't want to go out and spend all this money. In Allison's case, I know they're working on like a hybrid transmission for tanks for the Abrams. This concept of mild hybridization technology so that you could have quieter, I guess, main battle tanks. But again, I don't think you're going to see fully electrified main battle tanks anytime soon, because most battlefields don't have charging infrastructure around them.
No, I mean that was mostly crawling the last few yards in quiet, right, before getting ready to fire, and also being able to charge up and fire without running your main engine, which sounds like a which is, I mean, look, it's going to wake people up before you before you fire. These things are not quiet. But going back to Northrop for a second, so they walked away. They walked away from running the program, right? So they're not going to be prime. But you've got you've got a set of skills there that cannot be replaced. So anybody between Boeing and, well, it's simple choice now. It's Boeing or Lockheed. Now, assuming that there's still some level of tension and negativity between Lockheed and DoD versus over performance disappointments in F-35, and the level that the program is going to keep continuing for the next decade and a half without any let up. And you want to award the NGAT contract next year. It stands to reason that Boeing could take advantage of that, right? But it's Boeing after all, right? None of their defense programs are any less fucked up than LMT's programs, and that's the unfortunate part in all this is are they so they have been maintaining a line for these aircraft. They've not shut it down in the hope of winning a future fighter contract. So this is their last hurrah. If they get this deal, then they're going to get it with Northrop as a huge contributor one way or the other, right? So Northrop on the side of either Lockheed or Boeing is going to tip the scales. So it's a good thing for Northrop. But going back, why I brought this up was for Boeing. Now it really puts them back in play if they have a contract as a joint developer of this program with uh, with uh, with Northrop. That's a big positive on the defense side, and then you have the screw ups of Raytheon on the commercial side that could help them. So, long-winded way, I think there are significant reasons for Boeing to push up a lot from here. If it's a big if they can start delivering more 787s and clean that out, right? We're still producing 6 a month, 5 a month, something like that, and we still have about 85 planes. They did a decent job last quarter. They retired about 3 billion in debt, which leaves them at 52.5 billion this quarter. So 52.5 billion, and they still have, let's say, 80 planes at 200 billion. That's 16 billion in cash that cannot be recognized as revenue. That 16 billion is a built plane. Remember, all these need to be just checked, cleaned up, updated, done, signed off on any fixes, full maintenance check because it's been sitting too long, and then delivered. It's far easier than manufacturing one. My worry is what they are not saying. What they're not saying is is they're not delivering fast enough. But what my worry is some of these, the oldest of these undelivered planes are probably over 4 years old already. You have a 4 year old unused plane, and is it possible that the customers are pushing back and they want a newer build? If that is the case, it would account for two things, right? One, the slowness in delivery, because it's now a big negotiation. So then the other problem is, you have to push those out. So that means they are going to have to go discount these to whoever is willing to take them, and they're going to lose more than expected. So that is my only unknown, and it stands to reason it's one of those things, because
Monitor, it's
why?
fine. Ryanair will just take them off their hands for a discount.
Yeah, but Ryanair, you need to see most of those are manufactured for three class or two class configuration these days, right? So you have to rebuild the entire interior completely with what plastic seats, no foam, no luggage racks. you know, the
The
Ryanair
standing
Plus
room section
version,
that the
right?
CEO has talked about.
Yeah, exactly. So yeah, I mean, no, I mean, cut the bathrooms in half, all that stuff that Ryanair does. So that's an expensive. That's my point. Is something they're not saying that I suspect is happening. Outside of that, this should be a $300 stock in a matter of days. If we find out that's not the reason, and they have, maybe it's just taking them time to verify and ship these things. I don't believe that's the case. I do believe that they're having some problems with the customers. So anyway, that's my long-winded story on Boeing.
No, that's wonderful. A lot of good insights on aerospace and defense, Monitive. Appreciate it. I mean, the defense space, it's very clear from what I've been reading, right, that you're seeing a lot of older material getting consumed in the war, and therefore it needs to be replaced, and that is going to provide a nice long runway for both replacement of older stuff and putting in the new stuff. I don't follow it
Yeah,
nearly as
really.
closely as you, but I really appreciate it.
Yeah, 8x is the capacity upgrade in 2 years. That's the target. 8x of munitions capacity.
Wow.
What we had at the end of last year, we are going 8x in 2 years.
Lockheed trades at a 16 times forward. Um, I'm going to assume Raytheon's looks a little wonky, but yep, similar, 16.7 times forward. So, I mean, there's definitely, I know people like to say everything's expensive, but some of this stuff that's not sexy in defense doesn't strike me as that expensive in the context of what might be a continued impulse to spend on it. And that's what I took away from the Allison
Consider,
call is they expect to
consider
see
for a
most of their
second.
growth from international in defense.
Consider for a second. Okay, yeah, just on that international, right? Normally, international sales, right? FMS, foreign military sales, are about have been averaging about 50 to 55 billion in the last 5 years. This year, first 6 months, 77 billion. 6 months. I beat the crap out of any
Wow.
old record, right? This goes back to 1996, 1990 record, right? So we go back 30 years to see this kind of numbers in terms of growth between 2 years, or 1980, something like that. It's a very long ago number that we are completely overwhelming. So foreign military sales are just tearing up the records. It's just insane how many people are lined up to buy. And remember, the gear from US is far more expensive. The maintenance is far more expensive. Still, people are lined up because we've had one long defense expo going on there. Sadly, with loss of hundreds of thousands of lives, but it's a showcase for U.S. arms technology and it's out there to see the difference between, a Western manufactured gear and an Eastern one, and what's working, what's not. So decimated the Russian defense industry just by performance. But Northrop walking away from something that could be a $200 billion 50-year program, right? It shows you how much confidence they have in their ability to find sales in other places, right? So that's what I mean. This is a multi-decade market for all of these, and these guys have gone to defense and said, "Look, we're not doing anything unless you give us longer-term orders and commitments." So that's the big difference in the last 18 months. Is DoD has gone back to Congress to get approvals to give longer-term commitments, because the defense industry is saying, hey, we can't build stuff, we can't hire people, and you give us a 1 year order, it's not going to work. Give us a committed order, like these munitions orders are now 5 years.
Good stuff. Hadn't yet seen anyone else request to come up and speak. While we've obviously been talking aerospace and defense, if you want to talk about a different topic, any of the topics that we covered in the prepared remarks at the onset, feel free. We've been going for about an hour now, and happy to keep it open for another hour. If anyone in the audience has any questions or comments of their own, again, feel free to submit them either via the Twitter, responding to the spaces. If you want to come up and speak, feel free. Or if you're in the GME DD Discord, feel free to submit a question via text as well. I don't see anything queued up, Joe. We can keep talking defense, but if there's any other topics people want to touch on, please don't hesitate.
I haven't talked too much about the PLDY report feedback. How have you thought it's turned out so far?
I'd say overall, I was happy with the feedback. A lot of people had good things to say. Actually, when I spoke with Brian McGough at Hedgeye, he was commending the professionalism of the report. So I told him, to commend you on a lot of the aesthetics. So good job. I had done an interview yesterday with Jason Raznick at Benzinga. That'll probably be out next week, talking a bit more about it. But yeah, overall, I've been happy with the response, and I look forward to the next one that we do.
Still have the channel on Discord too. So if you're interested in Playboy, go to wook.gg, join the Discord server. Playboy channels under hot tickers. Pretty active discussion. I think it's been only getting more and more popular of a stock to discuss. And then there's obviously channels for other tickers. So check out wook.gg if you haven't yet already.
I see someone sharing news about Virtue Financial receiving a Wells notice in after hours. So that's unfortunate for me and my fellow Virtue investors to get that after hours on a Friday. It looks like the stock, it was down something like 5% if my internet could work after hours. But it looks like there will be something coming from SEC shortly on the back of that notice. And I apologize in advance, folks, if my internet goes out and the call gets rugged. I just heard a loud thunder. It's summertime here in Florida, and the grid is not very reliable at my subdivision, unfortunately. So just a heads up. Hey there, Steve.
Hey, what's going on? How's everything?
Pretty good. Anything on your mind?
Yeah, it's actually a lot of things since it's earnings season, but I'll just pick a couple of things. I know I've been kind of I wouldn't say I'm kind of vocal, but I've been saying this I think a couple of weeks ago about how there, if anything, will be outperforming in the large cap FANG stock will be Alphabet, because the data, and then it's the only company that's not getting that the multiple expansion yet. And then I guess I mean the result was definitely was kind of what I was expecting. I'll just take a couple of things I was in on the positive side is, you know, really the management really focused on cost management. So there's the margin, they will be to maintain a relatively healthy margin, giving uh, the AI, also the headcount reduction. Those the cost part, and then I would say search growth was I would say is pretty healthy, and then like I said, I think second half search growth recovery will definitely because due to the easy comps versus last year. So and then YouTube as well. The monetization value is ramping up the YouTube Shorts. You can see that based on the other social media data as well. I would say the only thing I would say that's well, this is not really a negative, but I would say uh, it's not really negative because you have Azure, Microsoft Azure also reported at the same time. So Google Cloud, right? They've been slowing because the enterprise focus on cost side of things, but they did outperform Azure in terms on terms growth in terms of growth expectation, right? So it was like I think Street was expecting like 7.9 billion or something year over year, and then they did like on top of 8 billion. And then also I think the growth rate was like 28% versus like 27% Azure. So it's not marginalized. It's not like huge, but still, I would say not too bad. I would say if you have to point out a couple negatives, right? So capex, so second half capex will grow. So that means like a lot of firms, like even Microsoft, even um, like such, they will invest in AI investments, right? So they're ramping up capex in next year. And then yeah, and then I think that's the one of the things. Maybe there's a couple of little chunk thing about like networking revenues, but overall it's really positive. I think people are not expecting just people think everything was run up because the large cap tag, but I was saying that this Google Alphabet was the only one that's not enjoyed the multiple expansion yet. So if history repeats itself like what Microsoft did after earnings, I think Alphabet can get their multiple expansion in the next couple of weeks. But anything can happen, right? But that's for Alphabet. And then okay, and then I'm
Yeah,
not gonna,
Alphabet's still trading from a to your point about multiple. The multiple is still below almost any point in the last 5 or so years.
yeah.
So I would agree with that kind of comment on Alphabet.
That was the alpha we'll say generation there, but now post earning I think if you're a trader probably the vol compression will make it more expensive for you to get. But yeah, for long term investor I think it's uh this is just one of the thing. Just I will say also just real quickly the Meta advertising trend is also the similar trend with the Alphabet earnings. So it was all positive read through from Meta. So that was an easy prediction as well for Meta to positive. Although the only thing is that I don't think people are reading the Snap's monetization value as much as in terms of the overall social media sector. I think people are overreacting in terms like how are they um, in terms monetizing their user base. But Yeah, I think what we'll see in the long term, I think Snap still relatively, you know, just relatively, still some potential in terms of capture, the short form media space. I mean, I know there's TikTok and there's other things, but I think people are just overreacting in terms of how people are expecting like a more positive outlook for the second half, but I think management, they always come out like this, like they always come out with this very conservative assumptions. But um, and then that's that. And then another thing I was gonna mention is the semiconductor space, right? So we had an Intel reported. I think one of the thing is, even though, like, Intel is, putting a lot of capex in AI stuff, this is a normal trend. This is a trend that we have been seeing. So the PC hardware space is being contracting in terms like the year-over-year growth rate and the demand side of things. So this is a read through from TSMC as well. So I don't know, like I said, AMD is definitely, it's a like two tell or two city here. Like AMD is trying to capture the AI side of things, but at the end of the day, there's still a pretty hardware driven uh direct competitor with Intel. And if you're reading at the Intel management comments, it seems like Intel is being be able to capture some of the market share in terms of the CPU space as well. So I don't know how it's gonna read through to AMD as well. So I know AMD had this 50% second half margin growth, but we have to see. They're reporting earnings next week, so it's not like it's not very straight see through compared to other straight AI plays such as, like I mentioned. I think I was talking to somebody else, right? Marvell Technology or uh, uh, other software names. So that's that. And then yeah, I think that's pretty much all. I mean, there's other things. I don't know if you did you talk about Overstock for read through for Wayfair. So Overstock coming. I thought we flipped the pages ready, but I have to mention Bad Bath & Beyond again. So like obviously they're pretty positive how their Bad Bath Beyond monetization in terms like the Canadian space, getting a lot of positive feedback. So I mean the management is really positive in terms their in terms you call it how they're gonna utilize the rest of the intangibles from Bad Bath Beyond to be able to grow their own TAM in the online space. So I think it's interesting. But yeah, I don't know if you look into how they read through in terms to Wayfair. I think Wayfair is a very like interesting name. I know you being kind of um, vocal on that, and sales side are pretty bullish. I think
I am
people,
short in my personal account on
yeah, I think
Wayfair,
people
just
are
so people know.
expecting a lot from them. Like, well, people are very wound out for this earning report. I don't know what else people are expecting. I mean, if they have an AI initiative or anything, but I just the online market trend in terms like furniture sales is stabilizing compared to like 2 years ago. So I don't have a clear outlook on this company, but it's interesting just to see some read through from Overstock.
Overstock definitely felt good about the early indicators they're seeing for the Bed Bath and Beyond rebrand that they've done in Canada. So I'm not sure how much of that read through, Steve, is like a broader, the trough is in for good spending, and we're going to see a resurgence in kind of these e-commerce bulky goods sellers. But I don't know. Are you expecting Wayfair to kind of report favorably based on the Overstock read through, or?
Well, I think everybody is. Well, I think a lot of people. The X-Men is not pretty high for Wayfair. Well, in terms like for them to showing a positive results based on what I'm seeing from some sales analysts estimate. So I don't have a expectation for Wayfair. Like I don't have a model on Wayfair. So
Yeah.
I think this company. It's I think isn't that very heavily shorted name? What's the short interest on this company? Like high 20s or something. So anything that's pretty heavily shorted, I don't want to. It's the fundamental. It kind of come into a very. It's different. Like I don't know how people are gonna react after earnings. It could be an okay report, and then people just saying, oh, it's great. Or the thing is, Wayfair is that the like I said, like Overstock being able to capture some of the market share, which what Bad Beyond, they're tangible. But Wayfair is a different story. So I mean, I mean, what's your like in terms, um, like what's your thinking in terms how they're gonna do this quarter?
I would expect them to, frankly, try to raise capital. I don't know how good the quarter is going to be. To me, it seems like it's already very rapidly priced in a very good result, considering in the last 2 months the stock has more than doubled. So it's a 8 billion market cap. Obviously, it could keep going, but no, I don't. I don't have really good things to say about Wayfair leadership, and I think they're frankly charlatans.
Yeah, I think there's a sales. I think there's a sell side upgraded today or something, right? To
Yeah,
like
I did see that. I thought, was it 80 or 88 from Wedbush? Which again, I don't know
yeah.
how you mark a stock as outperform when the price is within 10-ish% of where it trades. But I'm not a sell side analyst.
Yeah, I mean they're pretty positive in terms. I think these people are tracking traffic data on the because it's online, and I like I said, I check on Sensor Tower. They're being pretty positive. Like they're even doing 50 high 50% like last month. So, but I don't know how much those are priced in already, and
I mean,
it
when
could
it's
pull it.
that's my point, right? It added what, $4.5 billion in market cap in 45 or so days. I mean, that strikes me as pricing in some pretty good results. But this market has proven me wrong in that regard. These things, like you said, high short interest stuff. Um, if people decide to cover, can definitely send the price way up.
Yeah, I think like if they be able to show they can cut costs and then improve the margin, gross margin upside, I think there could be a potential positive way through for the just for temporary short term relief. But I don't know. It could be it could be go either way. It could be also pull like a Netflix how they run up the earnings and then they kind of had to retrace afterwards. So.
Yeah, apologies. My internet is just. I'm glad it hasn't shut the space down. It's giving me trouble and won't really let me search anything. Otherwise, I would tell you what the short interest trend had been.
Got to make the move out to California, Rod. Yes, Monative with the support. I mean, look, we don't have thunder, barely even have rain. Kind of forget about the weather even being
Tell me more about your
Hey, hey,
thing.
hey,
taxes.
The
hey!
taxes?
Don't. Hey, we make more money, so we pay more. That's all. It's just
Yeah, exactly.
Tell me more about your net income after taxes, cost of living, etc. Fuel.
well, we still feed the rest of the country, so can't complain.
Look, Rod, Florida for 183 days, California for the rest. There's your taxes.
Um,
Well, if you're going to go there, might as well go to Puerto Rico and not pay federal tax at all, and still be an American.
um, just to circle back to the short interest, which I do have on my screen, Steve, to your point, it is a highly shorted stock, Wayfair. In terms of kind of just eyeballing the short interest chart, though, I wouldn't say that there's a huge amount of like deeply underwater shorts. There's definitely some, like the short interest near the market cap trough in October when it got down to 3 billion market cap. That short interest was around 17%. It is 22% now, as I see it from the latest FINRA data. So there's some people clearly that have probably shorted it and are underwater. So I guess to your point, if there's a very solid result and they come out guns blazing, do you get a squeezy type pop? Personally, would just add to my short at that point, but obviously people could get blown out. So we'll see what happens. But going back to you know demographics and geography, I mean, it's really interesting. I heard in the Valero call yesterday them kind of talking about how good gasoline demand has been for them relative to the national data that the DOE puts out. I thought it was interesting because when you really, and I've made this point in some other of these conversations, there are very big geographical differences between how local economies are performing. And if you're Valero and you mostly have refiners in, say, Texas, where the economy's been quite hot, obviously the Southeast, Florida, those markets have been doing better than maybe some of the Northeastern or Midwestern or even Pacific West. So it's just, again, it gets back to, if you're buying a company that's like targeted geographic exposure to certain parts of the country, you just definitely have to think about different risks. And, I think about California actually as a part of the country that is maybe a bit of a laggard of late, and maybe they bounce back because they've already eaten through all of the layoffs they had to incur on technology. Who knows? But I don't know, just some thoughts. I will say, Joe, I've only been to California twice. I did enjoy my time when I visited San Francisco once, and the other time was for work in Southern California. So I didn't get to see much, but I did get to see a lovely haze as I descended.
You gotta come visit San Diego, Rod. Come on, it's everyone's favorite. Anyone who's been to LA, SF, and SD always picks San Diego as the favorite.
Yeah, I gotta agree there. San Diego's weather is just perfect. It's just perfect. I mean, I'd still prefer warmer water, even further south. But yeah, it's about as good as you can get.
Yeah, obviously swimming in Tampa and the ocean is obviously much nicer over on the Bayside. Warm weather. I don't know, it's the water so much warmer, but out here,
It's too hot in the summertime, frankly.
yeah. But in the winter, oh, that ocean is magnificent. We have better Mexican though.
Was there any question there? Of course, we have better Mexican food.
What is Florida? What's Florida's best food? What do you guys like specialize in over there?
If you like Cuban food, there's some good Cuban spots in both Tampa and Miami.
All right, all right. Next time I'm in Florida, Rod, you're gonna show me your favorite spot.
Well, to be fair, sailing is just a lot better in Florida. I got to give it to them. So,
And there's no storms in the Gulf. I mean, it's just a delight if you were going to go out on the water. That's a fact. I grew up. I mean, I don't know. I'm spoiled. I grew up in Long Island, 10 minutes from Fire Island, and I don't know. I don't need to live right on the water. I live like
So,
45 minutes from the Gulf.
talking about that, what is the prediction for the hurricane season? It looks like Generac has already started its run, and I missed it this year.
It blows me away, Monadip, that stock can just literally it's like a known that there's going to be a hurricane season. I'm sure someone's made money off of trading that cyclicality year over year.
50% in a month. The bloody thing is, this is like the most obvious trade that you don't take. Just stupid. Like on cue, as soon as the first predictions of the hurricane season come in, it starts moving.
So the NOAA prediction, it looks like, came out in late May, and they predicted a near normal Atlantic season. So May 25th, I see. Is I wonder, is that when Generac started to move?
Is the notorious Bangladesh butter production correlation to SPY.
But in terms of what is called for, NOAA for the outlook is calling for 12 to 17 named storms, 5 to 9 hurricanes, and 1 to 4 major hurricanes. Major hurricanes being a Cat 3 or above. But, I mean, with any forecast, right, it doesn't necessarily mean it's going to come out that way. Just in that vein, though, I've continued to read article after article about companies pulling out of insuring property in Florida. And I think I made the point in another chat about kind of how extraordinary the delta between insurance cost in, say, a panhandle town on the Florida side of the state line versus on the Alabama side is. You're talking about many multiples higher premium to insure property in the state of Florida versus, a comparable risk location in the state of Alabama. And, eventually, that, even though it's a small component of overall price, does that price more people out? And, if the state gets hit with some major hurricanes, then, which has happened in the past, what happens in terms of the state's finances? It's definitely a peculiar risk, somewhat unique to Florida. As anyone who insures an automobile in this state knows, it's extraordinarily expensive to do that. Homeowners insurance, just another pain point.
Yeah, we
I
should
just
have
hope I don't have to
earthquakes
put up
over here,
shutters
but
this year. I didn't enjoy doing that last year.
Ooh, yeah. How was? I remember you had a big scare last year.
Well, the storm that ended up making landfall, in Cape Coral and wiped out parts of Sanibel Island, that very easily could have gone right up into Tampa Bay. And there is a lot of low-lying land. If you kind of look at the map of Tampa Bay, if you were to look at the storm surge map of Tampa Bay, you can see that this area of Florida has been very fortunate for a very long time. But eventually, it's going to get hit with a big storm that pushes a ton of water into the bay and causes tens of billions in damage. It's just a matter of when, not if. All right, it's 5:30. Any other folks want to chime in, take us on to a different topic? Otherwise, Monda, Steve, if you guys want to talk on any other things, certainly happy to. Otherwise, we can wrap early. let folks start their weekend.
No, I don't have anything to add, man. I do really appreciate you giving me this space to talk here. It's not this is a nice space, you know. Not we don't get any crazies, and the discussion doesn't veer away, right? Like it happens in every other space. So thank you.
Monty, if you want me to go full doomer, you know, I could go full doomer.
Man,
Jeff,
you
but
know
thank
me.
you for that.
I'm actually not the crazy bullish guy. You know, I do sound bullish, but I'm
Yeah.
very circumspect about most things, and I'm pretty low risk profile, so I get off the train before things start going crazy. So I mean, I'm still positive on the economy and positive on parts of the market. I'm always positive on parts of the market, but economy is good. Just there's just too much data to deny that.
Yeah, without a doubt. Let me share, because I know people have heard me mention it before. One of the, I think, best newsletters is John Authors at Bloomberg. He does a great job. He always puts together some great charts, but he had several different ones in his newsletter last night. On business investment, showing continued personal consumption. Just look, if the reality is the data has continued to surprise to the upside. The city economic surprise index that he included, we're talking about highest surprise to the upside since early first quarter 2021. And the surprises have consistently been to the upside really since the year kicked off. So, look, if you're sitting there like, where was I wrong? I mean, I was wrong. Clearly, the consumer had a lot more firepower than maybe I thought, right? We all kind of got inundated with the headlines of recession is coming, I think, during 2022, which maybe helped the Fed to an extent. It's been in some of the different survey responses where I forget which exact survey, if it was the PMI, kind of one of the manufacturers talking about, we've been hearing about recession for so long, we just want to get it over with so that we can start building up like our orders. But no, it does not appear that there's an imminent recession. As I keep saying, though, I want to see what happens to the consumer as this toggle, this switch of repayments gets flipped back on for many of them. There are a lot of people who have student loans, and it's not an immaterial payment on average as a percent of their household income. So that'll be the sign to me is if we get through the holiday season with just continued robust consumer, then wow, there's no reason for we don't have to have a recession, right? There's just so much fiscal impulse out there. We talked about construction and where you're seeing a lot of spend and the need to build equipment to support that and put construction jobs, right? You would expect construction to have rolled over if we were going to be going down into a recession, and construction's just still plugging away. So it's just a really complicated and challenging market environment to have come out of a once in a century global pandemic with so much, so many bullwhips going on the good side and now kind of on the services side. I mean, as you said, Maud, there's aspects of the market that are overvalued. There are aspects of the market that there's opportunity. And, unless you're actually just DCAing into dollar cost averaging into the index, then you probably don't care as much about the index, and maybe you should care more about the individual securities if you are an owner of individual securities. But I would say most of the way, well, I don't know what percent we are now through earnings season as of today, but it's been a solid result. But I will say I still think that the outlook is a little too bright in terms of what is penciled in for earnings growth in 24 and 25. I mean, it's still like 12 or 13% for both of those years, which seems a little rich to me. But we'll see what happens.
Yeah, we're probably just near the 50% mark, but we are past the point where most of the marquees are already out of the way, except maybe Amazon and Apple. So the the chance of making the S&P earnings number is very high. We're going to beat that number, that $51 or whatever it was this quarter. We're going to solidly beat that number. And that also plays into what you just mentioned is the expectations were high, but we've been beating, and the expectations were brought down, and we've been beating, close to what the levels were originally. So it does look that it's a big climb, but at the end of this quarter, if instead of 51 we're somewhere near the 53, 54 mark, that's a 230 S&P earning for the year. So it's starting to go up. I mean, these numbers are big. So yeah, I don't know. Again, right, think of this. For the last few days, we've been hearing about more incentive coming in from the Chinese government to prop up their economy. One of these days, it's going to work. They've thrown a lot, they've tried a lot, nothing has worked. But if China's market does start moving, China's economy, not the market, I'm sorry. So China's economy does start moving. We have a hot economy in India. It makes a difference, right? That's three of the top five economies that are in good shape. It could be another leg up all on its own just for that reason.
So S&P closed a bit shy of 4,600. So you're saying it looks like full year 20 of this year we're running around 230. So I mean that's close to a 20 times earnings multiple. I guess that's where I like on its face that feels stretched. It doesn't mean it's a bubble. It's just a rich valuation at the index level. But obviously you don't have to buy the index, and there are companies within the index that deserve a multiple that is higher than the index multiple. Some of the growthier, higher margin, better businesses, technology businesses in particular. So yeah, I mean
So
it got
Google,
to the mid 20s
Google's
before. It could could expand further.
look. Meta is a forward 18 or 19. Google is a forward 22. Apple is a forward 30, and Microsoft is a forward 32. So yeah, some are ridiculously expensive, but some are just a bit expensive, and some are cheap, right? So again, I think S&P is more for individuals that can analyze stocks and spend some time doing both fundamental technical analysis. Index will always give you suboptimal returns if you know how to pick, right? So I mean, index to me is a marker, not not an investable thesis. Of course, 401ks and all those keep going in, and they keep pushing it. But I use index as a sentiment marker and an overall market marker. But my investment decisions are not based on what S&P is earning. It's just another data point for me. That's all. So anyway, I think I'm sort of exhausted for this week. So
You're good.
I,
You're good, man. Appreciate
yeah,
it.
I have my earnings space on Sunday, so this should be a good week to go through a lot of news here. So
Awesome. Yes, I will try to tune in. And I encourage folks to give Monative a follow. If you want someone who's going to, I think, provide even keeled, intended to be objective, analysis and views, he's one of the best to kind of fit that bill. So definitely, wish there were more people of that nature on Spaces and around the interwebs. But look, the hype is going to get the views. Clearly, with what I see on my For You page nowadays in Twitter, the perhaps lack of clothing also gets the views and the clicks. But there are still some parts. You can find some serious analysis and discussion here on this platform in its perhaps waning days. But Mr. Sick One, always good to hear from you, sir. Did you want to share some thoughts before we kind of wrap things up in the next 15 or so?
Yeah, I kind of missed the conversation about trying to get you out to California, dude. I mean, like even with like me, and then there's also Chris R in the LA area, so it's like two more that to bring you out over in this area, and I'll also speak on Monative. He's got an amazing space every Sundays. It would be a lot more fun if it wasn't just for the fact that like I'm kind of hungover also on Sundays usually, since Saturdays are my like only days that I'm able to go.
That's some proper Southern Californian behavior right there.
I know. And then I don't know. Like I think I honestly do think if Rod is able to move out here, I think you'd like it. I mean, there's like a lot of financial bros out here, and then a lot of tech and VC bros also that you could like just shoot the shit with. So there, you'll find your niche if you do.
And Playboy.
Oh yeah. Oh yeah.
I'll show up at Playboy headquarters and say hi to Ben.
Yeah, like actually I know where they are, so it's like in West LA. Right if I remember correctly, it's just like literally south of UCLA. So who
Oh
knows? Maybe if
yeah, gotta
CEO.
gotta put the headquarters right down near UCLA. Wonder
Well,
whose
of
decision
course,
that
you have
was.
like what 40,000 customers there.
I remember the original headquarters before they moved. Also, like they were literally next to Live Nation in the little corridor between Century City and Beverly Hills on the way to UCLA. Off wasn't Sunset, was it, or Santa Monica Boulevard? On that one street. Google also has space out over there in that area too. But yeah, like I think they shrunk down, right? If I don't know if anyone's really tracking their office space usage, but um,
There's been multiple rounds of layoffs, so there's really no reason for them to have a big dedicated high cost office like that. It's just one of many things that needs to be fixed. But
I mean, like I could make that same argument for like pretty much any tech company, also, unless like you're working in a factory or like a server space. Like you could literally do every single job, or like 90% of most jobs, like at home with internet connection. Half the time, everyone's either doing a spreadsheet or like some document or like some PowerPoint presentation, and then that's essentially just it, right?
look, it's definitely role dependent. I know, when I was at Ryder during when COVID hit, right? I worked on the corporate strategy team, and for that sort of work, it was very easy for us to continue working effectively remotely because there's a lot of reading of reports, reading of news, of earnings results, etc. And you're communicating with one another and sharing thinking and the like. And it's not a creative type of role where you maybe need to or would benefit from being in the room together and physically whiteboarding things out like that. So we, I felt like for that role, it was we were just as effective. Obviously, it lowers costs. Interestingly enough, Ryder went ahead and sold that headquarters building this past year because they didn't need so much capacity anymore. So I'm sure they are not the only one. I know there've been plenty that they were trying to lean into hybrid as kind of the de facto way of doing business, but that does mean less space is needed on net if you're going to have people coming in only a few times a week. So um, there's definitely going to be a lot of changes to some downtown office spaces. You're going to have repurposing of some buildings potentially into residential or mixed use. But I think it would be silly to think that things will revert back to like the levels of hybrid work seen pre-COVID. I have to think that's a permanent change and shift higher. And it does seem like most are leaning toward not full remote, but hybrid. I know my partner, she works at a large GSIB, and they are kind of mandating that people come in 3 days a week now, even if they don't have anyone on site that works in their function. So it's like you still have some maybe rules that are less flexible than they should be. But again, if you're a big bank and you have all this office space, you don't want it just sitting there idle. So there's a balancing act for sure.
Yeah, and then like every single interview I've been through, they always ask me, it's like, oh yeah, we're going back to hybrid. We're in the office like 3 days a week. Are you okay with it? I'm like, hey, I guess so. I mean, like it's work. So, um, Yeah, and then I also want to throw out one other comment because I know you gotta like step out pretty soon. Um, I don't know, like maybe it's like the paranoid in me. I don't think it's like a once in 100 year pandemic. Like I got a feeling like we're gonna see something like similar like within the next 20 years. Mainly because like I look at Korea kind of like as the model. Korea's like proximity to China within a span of 20 years. If you remember, South Korea had to deal with SARS, H1N1, avian bird flu, MERS, foot and mouth disease. Crap, there was a couple others. Oh, um, shoot, it's like 7 or 8 different like viruses like being in that entire region. And then like if you ever landed in Incheon before the pandemic, they always had thermal cameras just like checking everybody that lands and with population growth and like just like the way that people are interacting and getting closer with like the regions where there are different pathogens. I mean, we kind of got lucky off of the Ebola scare back in the mid 2000s, if I remember correctly. But I kind of feel like we might see another one in the next 5 or 10 years. So that's why I don't think it might not be like a once in 100 year pandemic. Not to be a downer or anything, but that's just the thought that I just had right now.
And it's impossible to ignore that humans are far more mobile today than they were 100 years, 50 years, even 25 years ago. So the propensity for disease to spread more quickly globally has never been higher, and it's only going to go up, I would think. So hopefully you're wrong, but it's a valid point.
Yeah, like I'm hoping that I'm wrong, but at least on the bright side, if it were to ever happen again, we could always go back to working from home.
I don't want to end on this. somebody say something.
Sorry, all right.
Say something
On a
good.
brighter note, come out to LA. Weather's fantastic. And no need for hurricanes. Maybe an earthquake here or there. But actually, one other question. Am I too late to get on the Generac play? Is it like is it already priced in? Like everybody made their positions in? You think?
I don't know Generac well enough. Monitored. I don't know if you specifically follow Generac. I mean, Generac, that is just a wild 5-year stock chart with the incredible run in 2021, and it's retraced much of the COVID gains. But I never like buying a stock after it's run up 30 to 50% in the last month or two, because to me the question would be what has fundamentally changed about Generac's business, and I'm inclined to think it's just noise. On its face, it's not cheap, but again, I don't know the business intimately.
They're also selling, battery storage systems and things like that. The problem with that is it's one of those, you're really trying to compete against, the professional grifter and expect to, get anywhere with it. It's a tough business for anybody outside Tesla because they just taken this to an art form to find and squeeze out every possible federal dollar there is for any incentive across any product line, right? So I don't know, it's the scale for making battery packs at a reasonable cost is very large, and without being able to spread it over half a dozen businesses that they have, Tesla can, or being able to spread it over half a dozen businesses, Tesla can, bring down their cost of a battery pack and they can make a lot more of these. But somebody like Generac is probably going to be OEMing all of that, which means, you're working on tight margins and you're working on a product that whose price is, going to be driven by the larger use cases. So I don't know. So it should be valued as a as an emergency power generator company and not anything else. And for that, you should go back to what they were a few years ago and look at the
Yeah,
numbers.
right now, the multiple is richer than it was at any point preceding COVID in the company's history. From an EV to EBIT perspective, it's at like 19 times forward. So, uh, I would argue that it feels pretty rich to me, but I also, to Monadev's point, don't know about what their kind of go-to-market strategy in stationary storage that's not a traditional diesel type generator product looks like. And I would agree with the sentiment that it's really tough to make money in battery like energy storage. You need to be the low cost
Yeah,
manufacturer
look
because
at
I think it's going to
Enphase.
largely be commoditized.
Yeah, Enphase imploded. They also entered that business. I mean, their results are coming down to earth again. It's not just getting in because that seems to be where the market is going without being able to source it cheaply enough to be able to push it out in enough volume. I think it's sort of like they know that end market because they've been playing that end market and they thought they'd hit the same end market with a different product which they don't know at all. That's a tough sell for me. But it is still a seasonal stock. There's still a seasonality to it that seems very profitable year in year out. That's the only reason why it interests me, not as an investment, unless some inflection happens that I don't see today.
Okay. Like I'm looking at like some of the charts.
It is uncanny, Monolith, just looking visually, and I'm not using any sort of statistical analysis here, but your sentiment that it looks like the multiple just pops kind of every time we get into hurricane season. I see several years of that being a consistent theme. So there's got to be someone out there who's making money year in, year out on Generac trading.
I mean, look, you get a dozen of these stocks, just trade them and nothing else, and leave it alone the rest of the time, and have the discipline to not force a trade. You're probably going to do better than the market overall. It's not that difficult.
All right, well, let me just recap then what we have coming. So for for folks who didn't see the memo, we did postpone the book club until Tuesday of this coming week. I was feeling a little under the weather on Tuesday, so that will be on Howard Marks' Mastering the Market Cycle, 8 o'clock. We'll be here on Spaces, and if you've read it, would love to hear people share their thoughts on it. Even if you haven't read it, you're welcome to tune in and listen to the discussion. So that'll be Tuesday at 8 p.m. We'll also be back with our open mic that we do on Wednesday nights, 7 to 9 or so. We are, as we kind of alluded to, looking to round out our scheduling. We'll look to have a Monday program at some point soon, so that it's a Monday, Wednesday, Friday. We don't yet have that finalized, but look for that in the coming future. And then, of course, the Friday call that we're on right now, that usually runs around 4 to 6 Eastern. That we'll be back with that next week as well. So be sure to give the @Wook Capital handle, my personal @Rod Alsman handle, Joe's @Toast handle, as well as the @GMEDD handle that we will be using more regularly for other due diligence oriented discussions, so that you don't miss anything. So as always, Monative, and I know Steve left, but thank you both, and Sick, appreciate you guys bringing value to the conversation that is hopefully accretive to people's afternoons. And that's our intention, is to try and uncover and share information and insights that are hopefully helpful. And we will continue at it. So if you didn't get the opportunity to check out our PLBYDD research report, we would always welcome any feedback you may have. I did mention when we went through the review that my intention, unless things change, is to oppose Mr. Cohn's board seat at the 2024 annual general meeting. And I am a significant beneficial owner myself, and will do everything in my power to defeat him. So there will be more on that in the coming months. I am sure of it. So anyways, hope everyone has a good rest of their Friday. Stay safe out there, and we will talk to you soon. So cheers, everyone.